The market hates Duolingo stock right now. It's down over 50% in the last 12 months. Investors are worried about the company's user growth and monetization strategy. But have these investor fears created a massive opportunity to buy a potential multi-bagger on sale? That's the question we'll be answering in today's video. We'll look at Duolingo's business model, moats, and fundamentals. I'll also reveal my Duolingo stock valuation model towards the end. As long-term investors, the first thing that we need to understand about Duolingo is their business model. This is what the company actually does and how they make money. The simplest explanation is that Duolingo provides education services via the Duolingo app. The reason I specify education is because Duolingo is more than just a language learning app. They now provide courses for math, music, and chess alongside languages. But how does Duolingo actually make money from their app? After all, if you really wanted to, you could just access Duolingo for free. But for those users that want additional content, unlimited hearts, and no ads, Duolingo offers subscription tiers. These include Super Duolingo Family, and Duolingo Max. Duolingo Max is their most advanced tier, which includes AI-enabled features like video call, roleplay, and explain my answer. Duolingo Max's AI features were built on top of ChatGPT. There was a narrative being spread by investors that AI would disrupt Duolingo's business. But considering the way in which Duolingo is implementing AI into their own product, that narrative seems like a major misconception. But in terms of the actual numbers, we can see here that Duolingo produced over $250 million in subscription revenue last quarter, up from $211 million 1 year ago. That's growth of 22% in the past year. This completely contradicts the AI disruption narrative. More recently, Duolingo's management team announced a new strategy. They'd previously been focusing on monetization, basically extracting as much revenue out of their existing user base as possible. That's why paid subscriber penetration, which is the amount of daily users who became paid subscribers, grew from 6.2% in Q4 2021 to a peak of 9.2% in Q4 2025. Since then, the strategy has shifted. The company is now focused on growing the total number of daily active users. Duolingo reported 58.7 million daily active users last quarter, representing year-over-year growth of 23%. But you'll notice that user growth has slowed, indicated by the average 5-year growth of 45%. That's part of the reason for the shift back towards prioritizing daily user growth over monetization. But deprioritizing monetization is the last thing that Wall Street wants to hear, and that's why Duolingo's stock price is down so dramatically over the past year. But if we're taking the long-term view, prioritizing user growth is actually the smart move because it ensures that Duolingo remains the dominant player in its market. If Duolingo continued to pull on the monetization lever, they might end up losing market share to a competitor. So now we understand Duolingo's business model, but we also need to understand their competitive advantages, or their moat, as Warren Buffett would say. These are the attributes that help the company maintain their leading market position. Duolingo's moat is actually wider than many investors give them credit for. In software-based businesses, data is everything. It allows a business to continually improve its product over time. This applies to Duolingo more than you might have thought. The reason why competitors can't replicate Duolingo's success is because of their user data. At Duolingo's scale, with almost 60 million daily active users, they have the largest data set in the education technology market. With all of this user data, they can improve the quality of their lessons inside the Duolingo app. They can figure out how to keep users on the app for longer and get them using it more frequently. There's all sorts of little things like notifications, for example, which Duolingo uses to keep learners engaged. Duolingo's focus on testing new features and using the data to make calculated decisions is what made the product so effective in the first place, to the point where users will confidently recommend Duolingo to their friends and family. It's believed that roughly 80% of Duolingo's user growth comes organically from word of mouth. That fact alone suggests that Duolingo has one of the strongest consumer brands in the world. And think about what that does for them when they introduce math, music, and chess. Trust is already so high that users won't think twice about trying out new subjects. They could even have new users signing up explicitly for those other subjects, which expands Duolingo's total addressable market. So now we should understand Duolingo's moat. But what about their fundamentals? Do the numbers actually back up the story? Well, if we take a look at free cash flow, this is the money left over after all expenses are paid. You can see how Duolingo just continues to compound over time. Free cash flow hit a record of $232 million last quarter, up 160% year over year. So although monetization is taking a backseat with user growth as the priority, the underlying profits of the business are stronger than ever. Although Duolingo does have a high percentage of stock-based compensation. Stock-based compensation is when a company pays employees with its own shares. This is generally perceived negatively by investors because it dilutes the ownership of existing shareholders. However, if we look at Duolingo's free cash flow adjusted for the impact of stock-based compensation, you'll notice that it's growing faster than unadjusted free cash flow. That's actually a really positive sign because it shows that free cash flow is growing faster than the company's stock-based compensation, meaning that in Duolingo's case, stock-based compensation isn't something that investors should fear. Now I'm going to show you something that I find very interesting about Duolingo. Here you can see the company's cash and debt. The first thing you might notice is that Duolingo doesn't have any debt. The second thing you might notice, and that I really want to highlight, is the amount of cash that Duolingo has at its disposal. Duolingo is currently sitting on over $1.3 billion in cash. Just to put that into perspective, the company's current market cap, meaning the total value of the business, is $6.3 billion. So if we do the math, Duolingo stock is currently trading at less than 5 times its cash position. Or you could look at it as 20% of the company's value is in cash. This is very rare, but just how profitable is Duolingo? You can see from their operating margin that the company recently swung from the negative up to 15% operating margins. In the last quarter, operating margin declined to 11%, which is mainly due to the company's strategic shift towards user growth and AI-related product investments. Now it's time for your favorite part of the show. We're going to take a look at Duolingo's current valuation, and then I'll walk you through my base, bear, and bull case scenarios. If we take a look at Duolingo's price to earnings multiple, you might think that the stock is expensive. It's currently trading at a 48 forward PE ratio. Forward PE is based on the company's expected earnings over the next 12 months. But the PE ratio is quite an unreliable valuation metric for Duolingo because subscription revenue is accounted for over time. In reality, Duolingo receives the cash up front. This makes free cash flow a much more reliable way to value Duolingo stock. So with that said, Duolingo stock currently trades at an 8% free cash flow yield. Even after accounting for stock-based compensation, Duolingo trades at a 6% free cash flow yield. Now I'm going to walk you through my base, bear, and bull case scenarios for Duolingo stock. This will help us calculate the stock price return we could expect based on the company's performance. In my base case, I'm assuming that Duolingo grows free cash flow per share at a rate of 20% over the next 5 years and trades at a 4% free cash flow yield. I think free cash flow per share could very reasonably compound at a rate of 20%. All it would take is for revenue to grow at 15%, a few percentage points of margin expansion, and some share buybacks along the way. In this scenario, Duolingo stock would increase from $130 to $750 per share in 5 years. That's an annual stock price return of 40%, or a more than 5x increase. But what about my bear case? My bear case assumes 15% free cash flow per share growth and a 5% free cash flow yield. In this scenario, Duolingo stock would still increase from $130 to $480 per share in 5 years. That's an annual stock price return of 29%, or more than 3x upside. So if that's my bear case, what about my bull case? My bull case assumes 25% free cash flow per share growth and a 3% free cash flow yield. In this scenario, Duolingo stock would increase from $130 to $1,220 per share in 5 years. That's an annual stock price return of 55%, or more than 9x upside. Let me know in the comments what you thought about the assumptions that I used for my base, bear, and bull case scenarios. As a long-term investor, I believe the most important thing is analyzing the business. For me, valuation is just an afterthought, but it's nice to see what kind of upside you could potentially get. I don't own any shares in Duolingo right now. I would like to buy, but due to the size of the company being at a $6 billion market cap, I wouldn't allocate enough of my portfolio for it to be a meaningful position. And I don't really like the idea of having a 0.5 to 1% position in the portfolio. It would just overcomplicate things. But I do think it looks like a very attractive buy at today's valuation if you believe that the business isn't going to be disrupted in any way.